Hello everyone, and thanks once again for tuning into our latest video. With the announcement from Pfizer on Monday that they are close to a vaccine for COVID-19, the market has reacted somewhat wildly, with many participants calling this the great value rotation at last. However, is this justified? Who better to ask than Fiona Harris, US equity specialist at JP Morgan? But before we start, if you haven't subscribed to the channel, it would be superb if you could. And if you enjoy the content, please show this by giving the video a like or perhaps even a comment and make it a nice one. So first of all, Fiona, it seems we are still many months away from a vaccine and actually being distributed to the global population. Are all of the moves that we've seen over recent days in airlines and cruise lines, has that been justified?
Yeah, Andrew, thanks for having me. It's delightful to talk with you. It's amazing. This market the excitement of the last, 10 months, now 11 months, we thought we'd seen it all. And then, we decided the market loved the announcement on the election and rallied 7% in 5 days. We thought that was it. And hey, presto, Monday morning, you all wake up to what is great news, the
Absolutely.
potential for a vaccine. Can I just say, it's not going to be in your Christmas stocking this year. Maybe next year.
Yep.
But the effectiveness of the vaccine is really unmatched. And I think that's where the euphoria came into the marketplace. This is what we've been waiting for, the world had been hoping for. And now we've a really potentially credible candidate. But this is just part of the journey. It's a long journey to get it into full testing, full approval, and into your Christmas stocking is more like probably 2021. For some of us, could even be 2022. So, but I think what the market looked at is actually 2021 doesn't have to be a wipeout. That we all won't be working from home. I've loved it. I know you've loved it. It's been a great way to connect with people, but that we will be able to think about summer vacation 2021. Maybe going to a restaurant, maybe going out more, interacting more, socializing more normality. And I think that's where, when we had that big rally on Monday, and I think, when we talk to clients, we do stress balance. We've stressed balanced all year and last year, because last year it was an aged recovery. This year we're in a recession. It's going to be a deep recession, but a shallow recession. We probably have troughed in data. It's improving, but balance is still needed because it's been such in our market. And we saw that on Monday. Value outperformed growth by 6% in one day.
Yeah.
Amazing. But again, it was sell all the winners, buy all the losers, particularly the deep value. And that's a short-term trend. That typically isn't a long-term, that's a reactionary trend. So one, it's been nice to see value doing well, but to get a more sustainable value rally, we need a couple of other ingredients, particularly the economy growing better, and then becomes earnings growth. So the earnings growth for next year for the more cyclical elements actually looks good. Industrials looks really good. Banks, not so much because of interest rates, but other parts of financials. So one, it's been great to see. Two, it tells you that you do need balance. But three, the sustainability of it, I think we've got a little bit more room to go.
Right.
And I think where we will probably end up with, Andrew, is probably a more balanced period. Not wild strings between value and growth, but if we think back to the 1980s, right? Some of your listeners may not have been investors back then, but we had similar returns. So again, that's what we're thinking of. There's great secular growth drivers in the value space. We're not talking about deep value. We're talking about really good secular growth drivers in the space that I think should be in both your portfolio. So that balance is essential. But honestly, to get that sustained value rally, we'll need higher economic growth and more going out. And that looks promising for next year, but when exactly is the key to it. So we're making the right strides, but it's going to take a bit more time.
Yeah, you mentioned balanced, and you also mentioned people getting rid of their winners, the traditional, the FANG stocks that have performed very, very well. What level, what kind of balance are we looking at between growth and value in their US equity allocations?
Yeah, I think, you do mention the FANG stocks, right? It's been an extremely narrow market. It's been great if you've had the names, but the other part of it is you have to think about managing risk. A market that's so narrow, it's a problem, right? Because if you're looking at the market overall, actually about 16% of the S&P is up 20% or more year to date. 16%. It's very small.
Absolutely.
And so we think about having that balance. And for each client, it's going to be different. It's going to be down to your age, your profile, also your risk appetite. Now, are you traditionally more of a value type investor? Do you like buying things at a discount? You can hold them, be patient, wait for the market to recognize them. Are you more get up and go, more exciting? You're a surfer rather than a walker, right? It depends on you and your risk profile, your age, what your retirement goals are. And that's really important. It's very much an individual decision. It has to be down to that level. And I think everybody will find that balance. But what I would say and stress is it shouldn't be the exclusion of one over the other. You're going to need both in your portfolio, particularly on the value side. For a lot of people, you get a nice income. You get, during downdraft periods, it typically does better in value, though this year it didn't. We think about that opportunity set when the economy is growing better. Typically, value's done good when the economy is growing 4% or more. That could be next year.
Yeah.
So the balance that you put to it, the emphasis you have is really on your overall profile. So I can't say what you should have, what I should have, but it's actually look at it. And I think that's where people look to financial advisors, so they can dig down and look at that overall profile, because very often there's risks there that you and I are not aware of. You could be a growth investor, but you actually could have more mature growth. You could be a value investor and have high interest rate risk. It's more than just saying value or growth, if that's okay, Andrew.
The conversation, across the news wires and certainly even today has been on growth versus value. But should investors be looking further down the cap spectrum and thinking more about large cap, mid cap, and small cap?
Yeah, I mean, we're talking about US equities here. So let's mention that, because small cap investing in the UK is very different than small cap investing in the US.
Absolutely.
We tend to be, everything in the US is bigger, including our market caps, right? And the small cap end, as what Klein pointed out to me in the UK recently, well, your small caps in the US sound more like our micro cap or our mid caps. It's just much higher up. And the small caps in the UK look more like a US micro cap. When we think about it, of course, value and growth is a great topic to have. Everybody's open to that debate. You can have that debate with anybody. And if your pubs are open, probably a counter table over a pint someday. But they're not. And it's very serious business when you're thinking about it. But I think if you look at the marketplace, you are correct. Value and growth is one aspect of it. Particularly in the US, small versus large is another aspect of it. So if you get that strong economic growth, that 4% plus economic growth, typically in the US, small caps lead the way because they're the most sensitive to the US domestic economy, the most exposed to it. And they typically do very well in that kind of environment. So I think, you have to look not just value and growth, but across the market cap spectrum as well. And it is challenging. Therefore, I always say to people, advice is so important because you can miss a lot of hidden gems. And I think that, again, is another one that if we do get that strong economic growth, we should see small caps doing well. And it's amazing. The market loved the election result.
Yeah.
There was uncertainty, but the market didn't have any uncertainty. And the S&P rallied over 7% over 5 days. And small caps outperformed large caps.
Yes.
Right? Because the risk, Andrew, and the tail end of higher corporate taxes is diminished to a certain extent. And I think that had been playing on them. So as much as we say we can think about what factors, what things you need in a marketplace for an area of the market to do well, sometimes the market decides it wants something else instead. Something else weighs in that decision making. So I think the removal of that tail risk of higher corporate taxes has helped them to a certain degree this year. But higher economic growth would help them longer term. Yeah,
and you mentioned the election, and obviously I can't finish up today without mentioning the election and the new president elect. Although obviously that's still up in the air, it's a bit of a crazy time. Do you feel that, and assuming that everything is as we expect it to be, and Biden becomes the next president, do you believe that will assist further sustainability within US equities and the performance that we've seen?
Yeah, and I mean, God, what will we think about 2020? Uncertainty. the unusual. You know, these are key words that you thought you'd seen everything in your career, and suddenly something new comes to the fore.
Absolutely.
Expect the unexpected. Can we just say that?
Yeah.
In terms of the election result, yeah, you're right. The market did like the outcome. Divided government is what we're probably thinking about at this stage. Because remember, it's not just who goes to sit in the White House come January, but also the makeup of Congress. And remember the polls, a little bit like the polls we've seen over the last 4 years. Don't trust the polls, because the polling was very different than what the election outcome looks to be. In fact, Trump probably outperformed versus the polls during the election, and Democrats definitely underperformed versus the polls during the election. But again, we're going to have a runoff in Georgia in January, so we won't fully know. Everything takes longer. But it looks like a divided government. And with that, then the tail risks go away. So the chances of higher taxes, remember the corporate taxes, individual taxes, is somewhat diminished. The higher infrastructure spend gets diminished to a certain degree. And so your hands are tied to a certain extent. But I think we will get stimulus. We will get some package put through, probably be a little bit skinnier. And so the market is looking at that actually, you know, it's kind of like Goldilocks, neither too hot nor too cold, just about right. We'll do okay.
I think that's a great way to wrap up. Yeah, the potential for a Goldilocks outcome, which after the annus horribilis that 2020 has been, I think I'll take that. I'll absolutely take that for the end of the year. Fiona, it's lovely to see you. It's lovely to talk to you. I'm sure we'll catch up. You stay safe, and yeah, thanks very much for your time today.
Same to you as well, Andrew. Take care.